Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Surbhi Upadhyay. And after 3 days of big losses, today at least the markets look like they're consolidating. So holding on to 22,200, mildly lower now on the Nifty and the Sensex. Banks are dragging the markets down. The Nifty Bank is down nearly about 300 points, but mid-caps are managing to hold flat. But the advanced decline ratio is positive. So that's good.
You know, Reema, it looked like a better morning, but I think things are changing very, very rapidly now. We should pull up the intraday charts because the mid-cap index was in the green. Now it's in the red. And now the Nifty is tracking a loss of around 80 points as well. We'll talk more about the markets as we go forward. But let's talk about IGL because that stock has been moving higher in trade after coming up with the fourth quarter numbers, which are largely in line. The company's EBITDA and margin missed street estimates, but volumes came in at a multi-quarter high. To discuss more about this, Sonal caught up with Kamal Kishore Chatwal, the MD of the company, and started off by asking him about the outlook for FY25. Take a look.
Yes, we gave an exit guidance of around 9 million, but we achieved 8.73 in the last quarter. Going forward, our guidance would be around 9, because full year it was 8.43. So next year it will be 9.5 million per day. That is our guidance. Slightly 2 to 3% lower than our estimate. Major reason has been that the declining volumes of BPC due to EV conversion, and whatever growth we could achieve in Delhi was absorbed in that decline. So going forward, we see that since 4% sale through BPC now, much is left. So we see that the price cut also, as well as the favorable potential with respect to alternate fuels. We feel that going forward, the conversions will pick up, as well as the new GAs will start contributing to the CNG as well as PNG sales.
Okay. You spoke about some impact because of conversion to EVs, and you also spoke about conversion in terms of gas vehicles. Can you give us these two numbers? What was the impact in terms of volumes because of conversion to EVs? And generally, what has been the quarterly conversion to CNG in terms of vehicles?
So in terms of vehicles, previous year we had around 14,000. So this year we did 15,500. So around 10-11% growth was there. As far as the conversion to the DTC volumes, so they are gone down from 3.5 lakh kg to 2 lakh kg. Right now we are doing 1.92. So that's the kind of decline there. But due to the conversion, favorable conversion, as well as the segment, passenger vehicle segment, there has been an increase. We see that our mix percentage has increased from 35% to 41%. And bus has declined from 25% to 19%. So we see the same thing playing out this year also, because as you know, the Delhi NCR, the community is a little longer. So 40 to 50% advantage with respect to alternate fuel is too much for them. So we feel the conversions will pick up. In addition to that, we are also focusing on improving customer experience with respect to rebranding stations, as well as reducing the wait time of consumers. So these factors would definitely help us improve.
Okay. Can you give us a sense of what the split was in terms of APM allocation, HPHT and spot LNG? And is this going to change going forward? In that case, what would the outlook on EBITDA per unit be?
So right now, the domestic allocation, including the HPHT, is at 72%. RLNG is at 28%. Previous year, it was 78% and 22% for RLNG. That has been the change. And going forward, we feel that since the domestic, there will be an increase in domestic production. So we feel the same levels to be maintained, but we do not feel that the APM allocation can increase, given the fact that new GAs will come on stream. Some gas has to be a minimum 6,000 is allocated to them. So we do not see that APM going forward increasing, but at the same time reducing as well.
Okay. So, we have been talking about this big threat coming in from EVs and the Delhi EV policy as well. What is IGL's plan or strategy in that case? Will you, going forward, diversify? Will you see more in terms of commercial LNG, EV charging stations? Do you have a capex in plan for that?
Yes, we have a strategy for diversification. other areas, but within the segment, the core segment of CNG and PNG also, we have a strategy in place that whatever volumes we are giving away to EV, so the new geographies, there is still a transition play possible there from diesel to PNG and then to EV. So we are into that space that we have huge volumes of medium and heavy commercial vehicle. They are the dumpers for ferrying mining material, sand, as well as the marble. So this segment is what we are focusing on. In that direction, we have started the pilot for GS, that's Banda and Hamirpur area, dumper activities there. There we are demonstrating by converting dumpers to CNG and then demonstrating the benefit to the consumers, as well as setting up big stations for refueling them. So with this, we feel that whatever volumes we lose in Delhi, say 3,000 buses are busy, those conversions can be offset converting those dumpers to.
Okay, all right. You've also signed an MOU with 2 technology partners to establish compressed biogas plant. Give us more sense, what's the capex here? By when will it be commercialized? And will that be a bigger part of your portfolio going forward? Because your peer MGL is also looking at biogas plants. The government has a big push here. What's the strategy?
In fact, not two. We signed with 4 technology, this MOU. And we plan to set up 15 to 16 biogas plants, especially in cities, the NCR region, which has a huge potential of MSW. Plants are not there. And we feel that IGL can pitch in there, solve the issue, as well as source the domestic gas for the country, rather demonstrate that this is a viable solution for India. Recently, we commissioned a plant in Karnal. Where it was an online in the sense that we connected it to our CGD network. Our belief is that unless the plant can be put online, it will always be a challenge to successfully run the plants, given the quality issues that are there in the. In case you have to have a consistent quality as well as the quantity going forward, it has to be an online station connected to a CGD network. That gives us the flexibility to operate 4 hours. Unlike the bio-CNG model, where you fill up a cascade, then the cascade goes and dispenses CNG, and then it again comes back, and then so there is a bit of a variation in the production quantity there. So that impacts the quality and that impacts the customer sentiment also.
Okay. All right.
So Delhi and NCR is the area where we feel that MSW can play a big role.
Okay, that's IGL for you. What a big move we're seeing in the stock. It's up 6.5%. Get into a break. On the other side, we'll invite the management of Sonata Software. The stock has taken a big knock post their numbers. Samir Dhir, the MD and CEO, joins in on the other side. Welcome back. Sonata Software is one of the casualties of the day. The stock is down 14% post its Q4 earnings. The company's IT services, the international IT services revenues have fallen by 2.4% on a quarter-on-quarter basis. Margins too have seen a decline of more than 300 basis points sequentially, coming in at 21.1%, the lowest in the last many quarters. Samir Dhir, Managing Director and the CEO at Sonata Software, now joins in. Samir, morning. This is Reema here. First, if you could tell us what happened in Q4. Why are we seeing such a sharp drop-off in your revenues?
Yeah, Reema, hi, morning. Thanks for having me. So I think at the back of a very solid FY24, we did hit a bump along the way in last quarter. And I think there are predominantly 2 reasons. There was one large deal that we were pursuing, and it was pretty much all set to start in January timeframe. And based on the customers' internal organizational changes, the leadership changes, they pushed the decision out by several months. So that whole deal, we had the cost baked into the quarter, but the revenue didn't materialize because of their internal changes. So we really got impacted on both sides. One, the revenue didn't come through. And second, we had the cost because of the deal that was fully almost loaded for the whole quarter. So that's one of the main reasons that hit us. And the second reason that was in the quarter, which is an exceptional item, is we had a softness in quant, which is a seasonal impact. We talked about it in the last quarter's earnings release as well. That was anticipated. But the combination of these two factors, a large deal push out and the quant seasonal factor, really hit us hard during the course of the quarter. But having said that, I think overall in the fiscal year, we made good progress. Y on Y, Sonata will still grow for the international business of about 34%. It's been one of the solid years for us, keeping Q4 softness aside, and tremendous work as a company. We closed 40 large contracts in the course of the year as well. So very proud in the whole for the year performance, but yes, we had a blip in the quarter, and we're confident that as we get into the next quarter, in the current quarter, which is April June quarter, we'll bounce back to growth on a moderate to slightly up basis.
So you're saying in Q1 the company will revert back to growth, but it's going to be modest growth. Is that what the guidance is?
Yeah, it'll be moderate growth and maybe.
So what is moderate growth? Like 1% kind of a quarter on quarter?
Between 1 to 3%, I think we should be able to clock in that zone, which is, in the current environment is still pretty good growth rate. But it will take us maybe 2 quarters to go back to our old growing ways that we were growing all along. This Q4 bump has really derailed us a little bit, but we're confident we'll fight back. And
so
like
Q1
I said,
and Q2 will see moderate growth of 1 to 3%, right? And then you're hopeful things bounce back in second half.
That's right. That's why we are seeing the year going right now.
And what about margins in the first half versus the second half? What is the guidance or the expectation?
I think the revenue and margin will follow pretty much the same trajectory. Will follow in Q1 at least the same trajectory of margin increment as well. And in Q2 we'll catch up back up again. But Q2 is also the wage increase quarter for us, so we'll get a little bit moderated as a one-time activity because we'll do the salary revisions in Q2 for the company as well.
So is there a rough range that you can guide to, Mr. Dheer, for the year as a whole? It's
very difficult to give. We don't actually give full year guidance, but I think the trajectory we see for the next 2 quarters is between 1 to 3%, and then post that as we make progress, we'll provide guidance for the whole year. But like I've been always talked about that we are confident of beating the industry benchmarks. I think the industry has guided for about 5 to 6% year on year. We'll definitely be ahead of industry significantly even in this year, despite our soft H1 start. But we'll catch back up in the later part of the year.
Okay, we'll be significantly ahead of the industry growth of 5 to 6% in FY25. That's the guidance coming in for the full year. What about the large deals? I think you're pursuing 67 large deals, but how is the conversion taking place? How much longer is it compared to what we've seen, say, 2 years back?
Yeah, so I think the large deal is something which we have been quite excited about. Last year, we closed about 14 large deals, and I think we expect the same momentum to continue. But one has to keep in mind that given the macroeconomic situation that we are in right now, there's definitely a delay in closing some of these deals. What was taking about 3 to 6 months is now taking 6 to 9 months, in certain cases even 12 months. So the decisioning cycles have slowed down quite significantly at this point in time. But because we have created a large funnel, we believe we have created an engine to really replicate the performance that we had last year. We'll probably close in excess of 10 deals again during the course of this year as well. That's our expectation going into the year. So we don't see any softness there, but just the gestation period of closing out is longer than anticipated right now.
So expect to close approximately 10 large deals versus 14 in the prior year. And the deal closure cycle has gone up from 3 to 6 months to 6 to 9 months.
That's correct. That's correct.
Okay. Cash in the books is close to about 1,100 crore rupees, give or take. How are you planning to spend it in FY25?
I think we have always talked about we want to be a cash positive company. We have made a large acquisition last year, as you all know. We acquired Quant. At this point in time, Quant is fully integrated, and we're very happy with the performance and the progress that Quant teams have made. I think going into the later part of the year, we'll be open to doing some M&A activities as well, but that will depend upon us finding the right properties. Right now, we want to just make sure that we consolidate the acquisition that we've already made. But overall, very pleased with the performance of both the properties, Encore, which was acquired about 3 years back, and Quant, which was acquired last year.
So you're open to doing an M&A in the second half of the year, H2?
If it's right property presents, we've always talked about it. If the right property presents itself, we'll absolutely be open to doing it. But we'll not do it for the sake of an M&A. We'll do it for the right reasons based on the strategy we outlined. If you recall, we've talked about we want to grow in the US market, in the Europe market, and in the vertical that we have called out, in the technology area we've called out. If we find the right property, we'll absolutely not be hesitating to do that. But that's more like a later part of this year discussion. Right now, we just want to put our head down and get the next 1 or 2 quarters back on growth because we had a bump along the way. We want to get back to our 1 to 3% quarter-on-quarter growth back again.
So 1 to 3% is Q1, Q2. What about in the second half of the year when you're hopeful that things pick up and accelerate? Will the company go back to a 4 to 6% kind of a growth trajectory? What's the hope?
Candidly, it's very difficult to predict right now because the market is changing quite rapidly. It's something that we cannot provide any guidance for. But like we said, we were expecting H2 to be better than H1. That's our current expectation going into the year. But we'll have to watch how the first half plays out. We want to get the current demand pattern that we have, the current deals that we have, the current pipeline that we have closed out, and then go from there. That's the way we're thinking about it right now.
That large deal, which you were anticipating to start in January, and it got delayed, has it started? And is there a risk that more such large deals face, some deferral? Yeah,
sure. I think the decisioning cycles are delaying. Like I said earlier, the 3 to 6 months has become 6 to 9 months right now. But we have buffered ourselves with a larger number of pipeline in the large deals. So as we move forward, we can continue to hit the benchmark that we have put for ourselves to closing large deals. So that's our current thinking. On the deal in itself that got deferred out from Q4, it is not lost. It is still very much in the play. It's hard to predict when will that deal materialize for us because the customer is going through some internal organization changes. As they stabilize their organization and the new leadership settles in, they evaluate their priorities. We'll probably know in about a couple of months as to what the decisioning time for that deal is.
Okay. But since the deal has not started already and Q1 has begun, a month and a half is almost through, of this particular quarter, will it impact margins or will Q1 margins be better than Q4?
Q1 margins will definitely recover in the same zone that we had guided the revenue to be. We'll think it'll recover from that basis. But the deal in itself probably is more like a Q2 deal, depending on when it closes out.
Thank you very much, Mr. Dheer, for providing clarity on what went wrong in Q4 and what the outlook is for FY25. So that's Sonata Software, confident about significantly outpacing the industry growth in FY25, margins to recover. They're hoping things pick up in the second half of the year, but Q1 and Q2 should see moderate growth. Get into a break. On the other side, we'll put the spotlight on a whole host of stocks. Stay tuned.
Welcome back. Here with us on Trading Hour. Let's take a look at some interesting result reactions that are playing out in the market right now. Focusing on 2 stocks to begin with. One is Voltas, which is still down about 4% on the back of what looked like a pretty weak quarter gone by. And the other is Navin Fluorine. Now, Navin Fluorine was interesting. First glance, the numbers didn't look great at all. But especially year on year, quarter on quarter, there's some growth. But the stock has recovered from the lows of the day. So let's get the analysis going behind this. We have Vamakshi joining us to tell us more on Voltas. And we have Sonal joining in to give us more details on what could be leading to that recovery on Navin Fluorine. Thanks for joining in, guys. Vamakshi, let me start with you first. Voltas, so pretty much an all-round miss?
Well, absolutely. A weak set of numbers have come in from Voltas. When we look at the top line, that has come in nearly 10% higher than what we were expecting. But it's a miss on EBITDA of almost 34%, and net profit has also come in over 50% lower than what we were expecting. Let me quickly take you through the numbers. Revenue saw an uptick of almost 42%, and this was largely driven by the growth in UCP, that is the unitary cooling products portfolio, as well as a nearly 47% jump in the EMP, that is the electromechanical projects business. business. But apart from that, when we look at the margins, they've declined sharply by almost 219 basis points on a year-on-year basis. Margins are now at almost 4.5%, and this is largely being driven by the losses in the EMP business that have remained elevated. In fact, the company has reported an EBIT loss for the EMP business for the 6th straight quarter. In fact, that is mainly on account of the provisions in the international business. But apart from that, the EBIT margin of the UCP business, which the street was expecting to actually improve, has also declined by almost 90 basis points on a year-on-year basis. Overall, EBITDA is down almost 12.6%, and the net profit is nearly 22.8% lower at 111 crores. Again, a miss as far as net profit is concerned. But apart from that, the key negatives this time around was the loss in market share in the REC segment. The market share has declined by almost 30 basis points on a year-on-year basis. And apart from that, the company also says that the international project business is also continuing to face a headwind. So overall, a weak set of numbers from Voltas, and as a result, the stock is taking a knock in the trading session today.
Okay, got that, Vamakshi. Thanks very much for that. So Voltas are reeling under pressure. Let's go across to Sonal now. As we just told you, that intraday chart on Naveen Fluorine is pointing towards some recovery. Sonal, what's the good and the bad in the numbers?
Well, it was a margin miss if we talk about the numbers. But yes, sequentially, there is a recovery, which was expected largely. If we talk about the YOY numbers, revenues have declined 14%, EBITDA is down 45%, margins are down almost 1,000 basis points at 18.3%, leading to a profit decline of 48%. On a sequential basis, the revenues have increased by 20%, EBITDA is up 45%, margins are up 315 basis points as well, but profits have declined by 10%. Now, let's talk about the segments. The specialty chemical segment saw good growth, 26% at 257 crore rupees, but that was the only segment that saw strong growth. If we talk about the HPP business, which grew at a larger pace in last couple of quarters, has seen growth of just 3% this quarter, and it is because of lower export realizations. CDMO saw a big hit, down 76% in terms of revenues, and the company says deferral of molecules impacted Q4 of FY24. The other thing which the street has been waiting for a long time is any clarity on the new CEO. There has been no announcement made on it, and it was December when Radhesh Welling had exited the company already, so they did get a lot of time to find a new CEO, but they have not been able to do that. Jeffrey says visibility on growth remains clouded, with management hopeful of recovery only in the second half. So there is no clear direction of how much they'll grow and in which segments they'll grow, something that they had been confident about earlier. MK says they've cut their estimates by 12 and 4% to factor in relatively subdued first half of FY25. So the indication was maybe recovery would come by in FY25, and there could be a clear recovery trend that the management will be able to talk about, but that hasn't come by.
Okay, thank you very much for that. Pidilite is the other one which is on our radar. I think the margins have missed street expectations. The company is up to their branding expenses. Mangalam joins in with the highlights. Mangalam.
Well, the internals for Pidilite this time around are strong, irrespective of the way the stock has moved, and that's largely because while there has been an optical miss on both the EBITDA as well as the net profit, the internals suggest improvement in business. What's good about Pidilite's numbers this time around? 2,900 crore revenue. The street was working with a number a little over 2,800 crores. The underlying volume growth in the consumer business has been 12.7%. Here too, the street was working with a number of 10 to 12%. Gross margins have improved by 660 basis points year on year, and quarter on quarter as well. There's been an improvement of 50 basis points. And the smaller part of their business, which is B2B, saw a volume growth of close to 25% as well. Now, what's missed the expectations? EBITDA coming in at 577 crores versus a poll of 600 crores. Margins a little shy of 20%, again, versus a poll of 21.4%. And the net profit as a result of which at 300 crores versus expectations of 400 crores. Why is that miss come about despite strong gross margins? Because the other expenses have increased by 25%. The company said they've invested more in brands and consumer-facing initiatives. Additionally, there has also been an exceptional loss of around 72 crores on sale of shares in a subsidiary. They've exited the Brazilian business here itself. But, the company has preponed their ad spend. So on a year-on-year basis, maybe the margins will remain in that 20 to 24% band itself. The rural markets for them have outpaced urban. And while they see short-term softness in demand, largely because of election, the medium terms looks good for them. So let's see how this pans out. The management is hopeful of recovery and double-digit volume growth in this year, along with margins being maintained at that 20 to 24% band that they've been speaking about.
Okay, all right, Mangalam, thank you very much for that. That's Pidilite, still down about 5%. as that result reaction plays out. We will, of course, get chatting with the company's management, the MD of Pidilite, at 12:30 p.m. today. So stay tuned for that conversation. Let's take a break on that note, come back on the other side, and we will discuss a couple of trading ideas with Mitesh Thakkar and look at the next levels to watch on the index.
Welcome back. Another stock under pressure post the numbers is Protean eGov. And here the street is disappointed by the margin performance. The margins of the company, which were hovering between 15 to 16% for the last many quarters, has come down to 9.9% in Q4 as the company keeps making investments. So the margin drop is a bit concerning. Also remember that there you have it, like very steady margins for the last many quarters since it listed. Also, the company has seen a fair amount of gain. It IPO'd in November of 2023 at an issue price of 792. So since then, the stock has already given you a bit of a return, 46%. So there is that profit booking which is set in. And also, even the top line growth of the company is fairly muted at just about 4.3%. So, you know, the margin growth, the top line growth has been subdued 4.5%, and plus that margin drop weighing on Protean eGov. Mitesh is now with us for a quick technical check on the market. Mitesh, morning. Thanks so much for joining in. First, thoughts on the day so far. How do you expect the second half to play out, and what would the advice be on stocks?
The day has been pretty good in the sense that we have had a gap down opening, and then there's lack of follow through beyond or below 22,200. I think if that level holds, then the second half would be stronger, and we might actually look at 22,320 in a best case scenario, 22,400. But this doesn't look like a big reversal, so it's still a bounce back from support levels, and that's the way we'll treat it. Only a closing below 22,200, 180 zones would be, negative and suggest further declines. So for the time being, hoping that it works out that way. On the stock side, I have a buy on Crompton. While Voltas has shown some bad numbers, Crompton has broken into fresh swing highs. That's a buy with a stop at 329 and a target of 350 can be looked at. And HDFC Bank is on the negative side. There's a gap opening today. This could see more declines. So sell here with a stop just above 1502. Look for targets of 1455.
Okay, Mitesh, today a lot of PSU stocks have rebounded all over again. I mean, we saw the last 2-3 days were a little quiet, but suddenly the entire pack, your PFC, REC, BPCL, Coal India, all of them are up. I mean, any PSU trades that you are taking as of now?
Yeah, I think, the idea is that the sector has been outperforming sector, and as the index kind of, stopped falling, these are the stocks which are trying to bounce back the fastest. But the one which appeals to me is Coal India. I think the stock, if you look at the last 3-4 weeks of price pattern, we have seen a couple of highs around 475, 480 zones. And on the lower side, 440 recently has acted as a good support. So I think it's consolidating sideways. A break above 475, 480, which is a good possibility looking at the indicators, should see the stock head towards 520 plus levels. So very positive over there. The rest, I would want to see and, try to buy them at lower levels.
Okay, thank you very much for that. Let's move on after a short break to Sasken Technology. Now, that stock is up close to about 10% post their Q4 numbers. Rajiv Modi from the company will join in on the other side.
Welcome back here with us on Trading Hour. Let's focus on Sasken. Now, that stock's actually has been surging quite a bit. It was up almost 10%. Last I checked, it was 6-7% higher. There we go. So that's a good response coming into the fourth quarter print. Now, the revenue growth on a sequential basis as well as a year-on-year basis has done very well in the fourth quarter. There you go. That's the 13% quarter-on-quarter revenue growth. That's scorching, and almost 6% year-on-year. The problem, however, is margin. The margin has come down very, very sharply to just about 1.9% in the fourth quarter. This is because of increased investments in the business. Let's discuss this with Rajiv Modi, Chairman and Managing Director at Sasken Technologies. Mr. Modi, thank you for joining in. So that's a very, very impressive top-line growth, quarter-on-quarter 13%. But it's coming at the cost of margin. So I want to start by understanding how long will these investments go on for? Have you pretty much sort of, taken the bulk of it, or will there be a spillover in Q1, Q2 as well? What is the nature of these investments? Can you tell us the quantum? And to what extent will the EBITDA margin continue to be impacted because of this?
So I think thank you first of all for having us. Morning to you all. On the margin front, I think we have investments that we have done in Q4, primarily on two fronts. One is on the long-term engagements that we signed up in Q3. We have spent monies on knowledge transfer in Q4, so those costs will come down. And also we have invested in headcount growth because we expect the momentum of growth to continue in the Q1 and beyond. So I think those investments will start showing results in Q1 and beyond in terms of improvement in the EBIT margins. The only two vectors that can impact the EBIT is the investments that we have made in the silicon business, which may run into negative for a quarter or two, but that should start becoming positive in Q3 onwards. And the investment that we have made in Japan, that will also start yielding results in Q3 as far as the positive EBIT is concerned. So I believe overall from an organization standpoint, we will see positive movement Q1 onwards as far as the EBIT margins are concerned.
So can you tell us, because you're saying some of these investments will continue to run, like you mentioned silicon, first of all, do you have to make more investments across various business verticals, business lines, even in Q1 and Q2? And even if you don't have to make any additional investments, what is going to be the shape and form of the margin recovery? You're at 1.9% at the end of Q4. What can we expect next couple of quarters? I mean, can you get to, let's say, at least mid-single digits by the first quarter itself?
Yeah, we expect to get to mid-single digits by first quarter itself, and then continue to improve from there. Because I think we will be adding what we call the capabilities that will start yielding revenues, and the revenue growth will be sharper. So we expect that to, frankly, impact Q2 onwards in moving even in more positive territory.
Just one clarification, mid-single digit margins come in Q1, Q2, or is it going to be only in the second half of the year? Because your press release says margins will be lower in the near term.
Yeah, so in Q1, Q2, we'll start showing the mid-single digit numbers. And then Q3 onwards, it will improve even better and move into the double-digit numbers.
So just a final word on margins, sir. You're saying second half, you could actually be attempting double-digit margins. Now, the last several quarters, got that. But in the last several quarters, the margin trajectory has been very lumpy and patchy. I mean, there are certain very high sort of margin quarters, EBITDA quarters, and some very low. On a steady state basis, let's say full year steady state basis, what's an aspirational band that you want to stabilize at, that you think you can stabilize at?
I think we will definitely stabilize by Q4 at about 15% EBIT margins. And from there, I think if we factor in the growth vector, we should manage it between 17-18% EBIT in the coming year.
Sorry, EBIT, not EBITDA margins of 14-15% by Q4.
That is correct.
Okay. Sir, this is premised on what sort of a revenue growth in the first half and in the second half, and even for the full year, if you could give us some estimates?
While we don't give the guidance, we definitely share with you all in terms of the order book that we have. So in Q4, we did an order book again of 28 million, which is new orders as well as renewals. I think some of the orders that we booked in Q4 have longer term trajectories of serving them over multiple years. So we are building momentum on our 60 by 4 by 3 strategy, and we are seeing good results around that. So honestly, we can say that we expect to grow significantly from where we are in the coming year. And that's giving us the comfort and the confidence on also the expansion of the margin that we expect in the financial year.
So any number for the FY25 revenue growth? Will it be double digit?
It will definitely be double digit.
Okay. Lower, upper end?
I'm sorry?
Lower end, low double digits, mid?
I think mid, you can say mid to upper end is double digit.
Mid to upper end in terms of
But
double-digit.
that would
And
mean
this-
90% because double digit could be 99. I'm not saying that, but at least definitely.
Yes, maybe mid to high teens would be a more appropriate.
Yeah, I think mid to high teens will be a more appropriate conversation.
Estimate for growth this year. So what about deal
Exactly.
wins? Is $29 million an approximate run rate? Can you do better?
I think in quarter four, definitely there were renewals that happened because some of the customers give us the renewals on the existing engagements during the during quarter four. But we are targeting new order wins in the coming quarters and expecting the growth to kind of reflect quarter on quarter from here onwards.
Okay. So so give us some sense on where you're seeing the maximum deal momentum. I mean, you spoke about this mid to high teens guidance for FY25. Just cut it up in terms of, geographies, sectors, and really what will drive it.
I think we are seeing good growths in automotive, in semiconductors, in the high growth, the likes of Google and Meta and all. So the hyperscalers primarily. So we are seeing good growth in all those areas with regards to the coming quarters. So we are focusing extensively on that. GICs is another vector which is showing a good growth trajectory, and we are focusing on that to drive our growth in the coming quarters and coming year.
So you said GIC. I didn't quite catch that.
The global India
GCCs.
Centers. The
Global
GCC.
Capability Centers. Got it.
Global Capability Centers, or GIC, GCC, same thing. We are seeing good growth over there also because a lot of work is moving from particularly Europe and the US into India. And that is a vector that we are really focusing and making sure that we meet our goal target on that one.
Mr. Modi, thank you very much for this conversation. Wish you all the very best.
Thank you so
SaaS
much.
Fintech,
Appreciate it.
Q4 margins were a bit subdued, but the street is looking ahead and the management is confident about EBIT margins improving to 14 to 15% by Q4 of FY25, 1 year down the line, with an improvement in revenues too, hitting mid to high teens kind of a top line growth. Get into a break. We have an announcement to share with all of you. Our upcoming live personal finance webinar, CNBC-TV18 Accelerate, will feature none other than top market expert Nilesh Shah, MD of Kotak Mahindra AMC, who will answer all your questions on managing your financing and also conducting a special masterclass on what not to do with your finances and the mistakes to avoid. CNBC-TV18 Accelerate, Personal Finance Handbook with Sonia Shenoy, will also feature 3 well-known experts. We'll dive into everything you need to know to master your finances, learn how to grow your wealth. Don't miss this chance. Join us on 11th of May, 9 a.m. We have limited seats. Scan the QR code on your screens to register.
Welcome back. Well, let's look at a lot of the major earnings that we are anticipating today. And from the Nifty, of course, Hero Moto is going to be reporting. We have Sonia joining in with the key expectations. Sonia, the stock's been doing well. At least the numbers, wholesale numbers have been looking good. But you tell us, so what about the earnings?
Oh, absolutely. So Hero MotoCorp, if you look at it, decent set of numbers is what we're expecting this quarter. On the top line, it'll be a healthy double-digit growth. A revenue growth of 13.5% is what we're looking at. The EBITDA will go up by about 26% for the company, while the profits are expected to surge to 1,066 crores versus 859 crores same time last year. Now, it was a steady growth in Q4, as you rightly pointed out. The volume growth that Hero MotoCorp saw was about 10% year-on-year, and the recovery was largely in the entry-level motorcycle segment, which indicates that there is a bit of a recovery in the rural market as well, and that is playing out in Hero MotoCorp's numbers. The margins as well are likely to increase a tad bit, about 40 basis points quarter-on-quarter at 14.4%. Now, remember, Hero MotoCorp is also the cheapest stock in the two-wheeler space currently. If you look at it, it's trading at about 18 times forward compared to its peers like Bajaj Auto, which are trading at 28 times, and TVS Motor trading at 37 times. Also, you've had some other positives like an improvement in the sales numbers over the last couple of months. In the month of April, in fact, Hero saw the strongest growth on the back of a low base, of course.
but the growth was almost 35%. So it's poised for, good set of numbers, and there is valuation headroom as well. Hence, the stock is going in strong into its earnings. Back to you.
Okay, thank you very much for that. And the other big one is going to be Larsen & Toubro. Vivek joins in with the street expectations. Vivek.
Well, that's right. So Larsen & Toubro, all eyes will be on that. A lot of focus will be on the management commentary as well. How exactly do they see FY25 panning out, especially in the context, number one, this being election year, there will be the election code of conduct, so ordering will slow down. And secondly, there have been worries in terms of Saudi Aramco capex being trimmed lower, and this is something that the street will have to watch out for. But in terms of how exactly is Q4 expected to pan out, revenues are seen higher by close to 10.5% on a year-on-year basis. EBITDA seen higher by 7.8% on a year-on-year basis, coming in close to the 7,520 crore mark. Margins are seen at 11.4%. Remember, the core EBITDA margin guidance for the EPC business, the company has guided in the range of 8.25 to 8.5%. So that will be another key monitorable. Coming to the bottom line, PAT is seen higher by 7%. Now, what was the company guidance at the end of Q3 FY24? Number one, they said that they will end FY24 with order inflow growth of well over 20%. They had earlier guided for an order inflow growth of just around 10 to 12% for FY24. So clear beat is expected and already baked in as far as the order inflow is concerned. Now, talking about the revenue growth, the company has given a qualitative guidance of high teen growth, and earlier that the earlier guidance that they had given at the start of the year was between 12 to 15%. Core EBITDA margin, like I mentioned, 8.25 to 8.5%. That's the range that the market is working with. The company did say that they're expecting a sequential improvement as far as margin is concerned in Q4, and they expect margin performance to be much better in FY25. So that is something that the analyst committee will hold the management to. These are the large basic points. Of course, order inflow momentum for FY25 and capex moderation in the Middle East is something that we will watch out for.
Okay, got that. Thank you very much, Vivek. So, two big numbers to watch out for today. And with that, it's a wrap on this edition of Trading Hour. Thank you for watching. Stay tuned. Halftime report coming up next.